Two people messaged me the same week. Both want dividend income. Both have $15,000 to start with. One of them spends the next 4 months building a spreadsheet, researching payout ratios, reading annual reports, handpicking 20 individual dividend stocks he's convinced are bulletproof. The other one buys one ticker, and closes the app. 18 months later, the spreadsheet guy is down 2 of his original 20 picks because they cut their dividends without warning, and he's spent roughly 200 hours managing a portfolio that's basically tracking the same market the other guy captured in 4 minutes. Same goal, same amount of money, wildly different amount of effort, and the guy who did less work is sleeping better and, so far, earning more. That's the entire dividend ETF versus individual stock debate in one story. But let's actually break down why this keeps happening, because there are real reasons to pick either side, and pretending one is always right would be lying to you. Here's the case for individual dividend stocks first, because it's not nothing. When you buy shares of an individual company, you own exactly what you chose, nothing more. You're not paying an expense ratio, even a tiny one, to a fund manager. If you pick 20 or 30 well-run companies with long dividend histories, your total costs over decades can be lower than an ETF's expense ratio, which sounds appealing until you actually look at what those expense ratios are. SCHD charges 0.06% a year. On a $100,000 portfolio, that's $60 a year. For that $60, you get instant diversification across 100 plus companies, professional rebalancing, and someone else deciding when a company's fundamentals have deteriorated enough to remove it from the fund. If your time is worth more than $60 a year, and for basically everyone reading this, it is. The math on I'll save the expense ratio falls apart fast. The other real argument for individual stocks is control. You decide exactly which companies you own. You can avoid an industry you don't believe in, overweight a sector you understand deeply, or build a portfolio tailored to your specific tax situation. If you're a genuine expert in, say, utility companies because you've worked in that industry for 15 years, that knowledge is a real edge. But be honest with yourself about whether that's you, or whether you're a person who watched a few YouTube videos and now feels like an expert. Those are very different starting points, and the market does not care which one you are before it takes your money. Now here's where individual stock picking actually goes wrong for most people, and I mean most people, not the outliers. The first problem is concentration risk disguised as diversification. Someone buys 15 dividend stocks and feels diversified. But if 8 of those 15 are banks, utilities, and telecoms, because those are the classic high-yield sectors, you've actually built a portfolio that's dangerously exposed to interest rate policy and regulatory risk. A real dividend ETF like SCHD or VIME spreads you across dozens of sectors automatically, weighted by rules, not vibes. The second problem is the dividend cut, and this is the one that actually destroys portfolios. A company doesn't warn you before it slashes its dividend. It just announces it, the stock drops 20% in a day because the market hates surprises, and now you own a company you picked specifically for its income that no longer provides that income and has lost a chunk of value on top of it. This happens more than people think. General Electric, once considered one of the safest dividend stocks in America, cut its dividend by over 90% between 2017 and 2018. AT&T cut its dividend in 2022 after decades of increases. These weren't obscure companies. They were exactly the kind of safe blue chip picks that individual stock pickers load up on. When you own a fund instead, one company cutting its dividend is a rounding error. When you own 15 stocks and one of your bigger positions cuts its dividend, it's a real hit to your income and your confidence. The third problem is the one nobody wants to admit. Most people who pick individual dividend stocks aren't actually doing real analysis. They're screening for high yield, checking that the company has increased its dividend for X years, and calling it done. That's not research, that's pattern matching, and the market is extremely good at punishing pattern matching. A study from S&P Dow Jones Indices found that over 15-year periods, Roughly 90% of actively managed large cap funds run by full-time professionals with research teams underperform their benchmark index. If professionals with Bloomberg terminals and finance degrees mostly can't beat a simple index over the long run, the odds that a retail investor doing this part-time is going to consistently outpick a rules-based dividend fund are not in your favor. So when does a dividend ETF actually win, structurally, not just for convenience? Instant diversification is the big one. We've covered that. But there's a second advantage people underrate: automatic quality control. Funds like SCHD don't just chase yield, they use a screening methodology that filters out companies with weak balance sheets, inconsistent earnings, or unsustainable payout ratios. That screening happens continuously and automatically. You don't have to notice that a company's debt load quietly doubled over 3 years. The fund's methodology already accounted for that. VIM takes a broader approach, prioritizing scale and consistency over the strictest quality filters. VIG focuses specifically on dividend growth history rather than current yield. Each of these funds is essentially outsourcing the research most individual investors were never going to do thoroughly anyway. There's also the tax and reinvestment mechanics, which people rarely think about until it's too late. Reinvesting dividends inside an ETF is one click, or fully automatic if you set up a DRIP. Reinvesting dividends across 20 individual stocks means 20 separate small purchases, sometimes at prices that make it hard to buy whole shares efficiently. And 20 separate cost basis records you'll eventually need to track for taxes. It's not impossible, plenty of people manage it, but it's friction. And friction is exactly the kind of thing that causes people to eventually just stop reinvesting properly. Here's the honest, unglamorous answer to which one you should actually do. If you enjoy researching individual companies, if you're going to genuinely read 10Ks and annual reports and actually track payout ratios and debt levels over time, not just once, but continuously, individual stocks can work and can even be enjoyable as a hobby that happens to build wealth. But be honest about whether you're going to keep doing that in year 4 when it's boring and nothing exciting is happening. If there's any doubt, and for most people there should be, a dividend ETF gives you the actual outcome you're after: growing, relatively reliable income, without requiring you to become an unpaid equity research analyst in your spare time. A hybrid approach is also completely reasonable. Some people put the bulk of their portfolio, 80 or 90%, into a core dividend ETF for the diversification and reliability, then use a smaller portion to handpick a handful of individual companies they genuinely understand and want to follow closely. That way, a bad pick can't meaningfully damage the whole plan. But you still get to scratch the itch of picking stocks if that's something you actually enjoy. The two people from the start of this video, the spreadsheet guy and the SCHD guy, aren't really a story about who's smarter. The spreadsheet guy might genuinely be sharper at reading a balance sheet, but dividend investing was never really a test of who can analyze a company best. It's a test of who can build something durable enough to survive their own mistakes and their own boredom for 30 years. Most of the time, boring wins.